Welcome to Remarkable Retail Podcast, Season 4, Episode 20. I'm Michael LeBlanc.
And I'm Steve Dennis.
Steve, back on the mic again. We got a great episode. We have a guest episode, Amit Sharma, founder and CEO of Narvar, and a great discussion around adding value and returns. And, you know, it's a really wide-ranging conversation. So, and he's winning all kinds of interesting awards. So, as a company, we're thrilled to have them on podcast. But first of all, how are you feeling? Like last episode, we were talking about your trip to
the emergency room.
Your trip to the emergency room as the cocktails work. Are you shifted types of cocktails yet, or how are you feeling? You sound good.
I am. I was going to say mostly drug free, just to kind of create a little bit of suspense. But no, I am through my
that's great.
My antibiotics, and they seem to have worked reasonably well. Not quite 100%, but I'm getting there.
That's great.
Yeah,
strong like bull. Very good.
Yes.
Well, that's great news. Let's jump into the news of the week. Since let's just plow right ahead. I mean, it's a lot going on. There's a lot of earnings. There's some movement in and around how retailers are starting to react or being forced to react, I guess we could say, to the variations in both the economy and changing consumer demand. Let's start with the results, which I guess are kind of a leading indicator. There's a whole bunch of retailers that put out results, keeping our friend Lauren Thomas quite busy.
Yeah, I think this had to be like the biggest retail earnings week of the season. Yeah. So yeah, we had Best Buy, Dick's Sporting Goods, Nordstrom, Macy's, Dollar General, you name it, seemed to report this week.
Yeah. So what are your, we don't want to go into the details of all of them, but what jumped out at you from the results that we saw so far this week?
Well, there are a few weeks. I mean, there's still, for the most part, there's some indications that consumers are willing to spend, but there was, just like we talked about, I think with Target and Walmart last week, Home Depot and others, there's definitely signs that a lot of the retailers are pretty worried about the rest of the year. A number of retailers basically took down their forecast. A couple of exceptions, but generally looks like there's signs of a pullback. The other thing that's, I think, pretty interesting, and I never miss an opportunity to say bifurcation.
Another angel just got it to me.
I know. We're as it relates to apparel, accessories, those sort of categories, pretty strong growth really now for the most part comparing to pretty weak numbers last year. So got to keep that in mind. But you've also got off-price apparel doing pretty well, and I think that has a lot to do with the economic conditions, inflation causing people to trade down. So kind of the high end doing well, off-price doing pretty well. So just kind of this overall kind of rebalancing we've talked about, where the categories that are kind of post-COVID categories that were really depressed starting to do well, whereas those kind of COVID categories, the home, the office products, the casual wear that were so robust, now starting to trend down. The other interesting thing is so many of the retailers reported their e-commerce sales to be, more or less flat, or even in some cases to be down. So that kind of moderation definitely is that, we've seen sort of from the big picture numbers. We're definitely seeing that bear out on the part of many of these retailers' reports. And then the other thing I think, which we'll be talking about probably for the rest of the year, is I keep hearing about this inventory glut, that they just have taken in more receipts than they were able to sell this past quarter. But presumably that could be really risky going forward as consumer demand starts to wane. So we'll look for, I think we mentioned this last week, good time to perhaps be in the market for certain categories of goods.
Yeah, I think it's such interesting because, I think retailers have still kind of got the, we're not just in time inventory. We'd rather have it than not have it kind of phase. I think that still exists. And there's lots of retailers who brought in things. Some arrived late. So I think the retailers are, I wouldn't say nervous about the amount of inventory they're carrying, but they want to make sure that they're going to action whatever they get to action sooner than later. Because I think inevitably, and we've been talking about this for many months, almost right back to the beginning of the pandemic, eventually consumers will shift to more normal patterns of going out and traveling and, less goods, more travel. Hey, I got a question for you. So how much do you pay per gallon for gas in Texas, where you are? I'm curious.
$4.50, I want to say.
$4.50 a gallon, right? Yeah. To give you an order of magnitude, we of course have liters, and to do the conversion, we're paying today $7.95 a gallon. When you think about how much money goes into the tank and how much is coming out of discretionary spending. I mean, it's just not insubstantial, particularly at any wage rate, at any value equation. But just to put a point on that, like we're seeing some significant draws down on discretionary spending, right?
Well, between gas and I think food inflation, at least in the U.S., has been in the order of 9-10%. So you think about those are, for a lot of people, those are very big categories of discretionary spending, or semi-discretionary spending. You got to eat and you got to get to work. So no, I think the squeeze there is going to be pretty tough. But if you look at just to segue to one thing we're going to talk about, if you look at Nordstrom's earnings performance, they surprised the street, and the stock was up quite a bit. I'm not sure why it was such a surprise. Everything we're talking about people going back to work, people going out, people traveling, that bodes well for Nordstrom. Also because they have a very high-end customer, that high-end customer, and they talked about in their earnings call, is not as squeezed by gas, by food. So I think it's a good,
They might drive Teslas, for example.
They might, right. Those Tesla people are so annoying.
All right. Well, looks like Amazon is hoping for something less, apparently. In the news, Amazon intends to sublet warehouses. Now, this is from the brokers more than it is, as always is the case from Amazon. They're not commenting, but they seem to be flexing the amount of warehouse capacity. So one of two things is going on. One is you talked about exuberance. They bought or arranged for too much, or two, their sales are not growing the way they anticipated, or three, a mix of the both. What do you make of all this?
I mean, there's a couple of different ways to look at it. The square footage that's being talked about, and I've actually heard that the number that was reported is actually lower than what is actually being shopped, but I can't completely verify that. But even the bigger number that's being shopped, it's still quite a small percentage of their total square footage. Sure. Yeah. But it is interesting. The last quarter, Amazon talked about how they had quite a bit of extra expense because they had way too much capacity. So you can understand their desire to try to manage that down. I would have assumed, but it sounds like I'm wrong, I would have assumed that they would be able to grow into that space over time. Obviously, it didn't manifest the way they thought, but I would have thought, well, they're 40% of e-commerce. E-commerce is going to continue to grow. They'll have to carry some extra cost for a few quarters. But if they're really trying to get out of these leases, and it seems to me like they've got they both went a little bit too crazy in terms of building capacity, which I think was more of a Bezos kind of style as opposed to a Andy Jassy sort of style.
Well, now that brings up an interesting point. If you listen to our friend Scott Galloway, he's surmising that Bezos is going to do a Howard Schultz. He's going to come back and back and back into the business. Because I don't know if this is enough of an indicator, but there's certainly a different style here. It's kind of like the Jobs versus, the next generation, where they're a little more focused on cost containment. Do you think there's a bit of that going on, or this is?
Well, I know Scott's been speculating Bezos might come back. I don't have any information on that one way or another, but I think it's pretty clear Jassy's style is considerably different than Bezos. He certainly seems generally more conservative. He seems to be more interested in making money in the short term. I mean, some of the things they've started to do, closing, even though I think the physical stores they closed were clearly not working, but one of his first moves were to close those experiments that weren't working, which not huge to the total, but
it does send a message, though, right? It does send a message.
Right, it does send a message. Yeah. So I do think that he is more of an operating financial type than
he's more Tim Cook than a Steve Jobs.
Yeah, for sure. And maybe that's what Amazon. Like I don't have an opinion strongly on that one way or another, but it is certainly interesting that the biggest operator of e-commerce supply chain is unable to grow into many millions of square footage. So I don't know what this says about do they know something? I mean, we've obviously been talking about the kind of irrational exuberance around e-commerce growth, and that it was starting to moderate quite a bit. And I think in Amazon's case, it's clear that they are getting to a point of maturity in some of their categories, which is why they're making the big push into physical retail, because I think that's an unlock for them. But it's going to be interesting to watch.
Last couple of quick things. So there's a couple of developments, let's call them footprints in the sand, around ultra-fast delivery and buy now, pay later. So both in the news, not for the right reason, so to speak. A couple of some layoffs and some layoffs. So are we seeing leading indicators here, or just a blip and more over exuberance? What do you think between, what is it, the Gorillas and Getter and Klarna?
Well, we've talked about whether or not this ultra fast delivery is economically viable on the sort of scale that would be implied by the number of companies that have been started and the sort of funding that's gone into it. And I've certainly been a skeptic of that, as a number of people have been. And it's starting to look like some rationalization is starting to come into the market, because we have seen some exits from major metro areas on the part of some of these players. We've seen some layoffs. So just this past week, both Gorillas and Getter did some pretty major layoffs. So there's a sense that some of these guys are really getting closer to running out of cash, and that they're having a hard time. Like the idea that they might go out and raise a bunch of money is starting to look pretty sketchy. So I think we're in a rationalization mode going forward. Buy now, pay later. There's a number of these companies. Many of them have gotten incredible valuations, and I think the combination you and I were talking about off mic. How much there is there? Are there too many players, even if it is a pretty sound model? But I think a lot of people are also getting spooked about the credit risk. Interest rates are going up. Lower income customers getting more stretched. That suggests that they're profit. There could be a considerable profit squeeze, a lot of write downs, that sort of stuff. So this might be a little bit of the canary in the coal mine. But Klarna, one of the big players, did do some big layoffs. I do think some of this, just kind of like we had in our last episode about the digitally native brands hitting a wall. It's not necessarily that some of these brands aren't viable businesses. It's whether they can operate at the scale. I mean, Afterpay got bought by Square for $39 billion. That's just one of the players, right? So when you think about, this segment being valued at one point, hundreds of billions of dollars with, relatively small revenues and no profits, you just kind of wonder like, well, maybe that's not that it's all going to go away by any stretch of the imagination, but, could it possibly be as big as many people thought it was a year or two ago?
Or are we partying like it's 1999? You and I lived through that, right? These crazy valuations that just went boom. All right. Well, listen, that's a lot of news going on. Let's leave it there, and let's get to our interview, which dives into a bunch of different elements that I think will really resonate with the listeners, with Amit Sharma, founder and CEO at Narvar.
Well, Michael and I are excited to welcome Amit Sharma to the podcast to talk about returns and all sorts of other things. Amit, welcome. How are you today?
Great, Steve. Thanks for having me.
You and I sort of kind of know each other for a little bit now, and you've been on our radar screen, so it's great to get you on the mic. What we usually like to do, just to kind of kick things off, is just have the guests just briefly share a little bit about their personal and professional journey, and then we'll jump into the topic at hand.
So I started my career, and the first half of my professional experiences were in the space of data and engineering, and a very different space in financial and investment banking, actually. And then the second half of my career has been in retail, e-commerce, and an intersection of supply chain and logistics. Started with Williams-Sonoma and Pottery Barn, spent a few years there as a supply chain analyst. And then I went on and joined Walmart, where I was looking at their e-commerce business from transportation, shipping, omni-channel, and the U.S. Domestic business. And then last tour of duty was at Apple, more on the customer experience globally, shipping, delivery, returns, all those areas. For a few years before I started Narvar almost 10 years ago, 2012.
So that seems like some pretty amazing experience. So tell us how you came to start Narvar, and what was the inspiration? What problems were you trying to solve? And then we'll dig into a little bit more as to how it all works.
Absolutely. I think first as a consumer, as a shopper myself, and second is being in the retail industry for a decade. So both of those factors played into me starting Narvar. Now, as a shopper, I wanted to have a consistent, convenient experience throughout the customer journey, not just on the shopping, but all the way to delivery and beyond. And I was observing and experiencing quite a few friction points and challenges and overheads that as a consumer we have to deal with when we shop online. So that was one piece that informed my decision to starting the company. And second is that, as companies as big as Walmart and Apple, they were focusing on more on the customer experience. So from the shipping and logistics, it's not about cheaper and faster, but even meeting the consumer needs and giving them the choice and convenience. So those were the few things that were in my mind. And how do we build tools and solutions that can be used by various businesses and e-commerce companies to really engage customers and throughout their e-commerce and shopping journey.
When you first got started, did you have a particular specific idea or technology as to how you were going to address things? Like what was that, foundational piece of Narvar when you got started?
Foundational piece actually was more on the business and the product side, less on the technology side. And the thing that I was focusing on is that there are various tools and technologies and companies where investors and public markets have spent billions, tens and hundreds of billions of dollars, where these tools are helping businesses to really for demand generation and user acquisition. However, I could not find tools and technologies to really retain shoppers and really engage shoppers throughout that life cycle. So it's less about customer acquisition, it's customer retention and expansion. And as big as Walmart and Apple, I couldn't find specific tools and technologies that were available back then for that companies can leverage. So that was the exact business problem that I had in mind to solve at Narvar.
It's super interesting. I mean, the three of us have been in this game one way, shape, or another for quite a while. I mean, the industry, whether it's catalog industry, Williams-Sonoma, e-commerce for decades, it feels like we'd be farther ahead than we are today in solving some of these problems. It's not like you lacked at your prior places resources. Walmart and Apple have ostensibly unlimited resources. So let's step back and say for the audience, what's the big picture of the friction points in the customer journey and the returns problem, and how do you dimensionalize that problem? And kind of a sub question is, how come we're not farther ahead this far along?
Yeah, I think so. If you look at a typical customer journey, especially in digital and commerce, and that is, a lot of time, energy, and money is focused on upstream funnel. So that means homepage and landing pages, category pages, and then really focusing on driving that optimization from product detail pages to shopping cart and checkout. And that's where most of the time, energy, and money is spent. And driving that conversion rate, pick your favorite number between 1% and 2%. That's where the conversion rate is online. So what is missing there is that when the transaction is complete, where customer is expressing their intention and value exchange happens in terms of completing that transaction where money exchanges hand at the time of checkout. However, in my opinion, the transaction is not complete until you have the full value exchange. That means delivering the goods and services to the end consumer. And I think I see that as a big disconnect where merchants and customer brands believe that they have taken the order and order is complete at the time of checkout. And consumers and shoppers believe you have to deliver the goods and the services around it. And that's where I saw the gap and the friction point. And most of the companies are focusing on in the front half of the funnel from homepage to checkout, where consumers are expecting from checkout to delivery.
Okay, so you're in front of prospective clients. You've got a great roster of clients, but you're in front of a prospective client who do they see this challenge? Like, how do you sit in front of them and dimensionalize the opportunity? Because as you said, they may approach it from, there's nothing wrong. I mean, what is it that you're here to fix for us? And what are you going to fix for our consumers? And is there an environmental sustainability part? So talk about that for a little bit. That kind of, I don't want to call it an elevator pitch, but you got to get to the core value pretty quickly with, I'm sure, your prospective customers. What is it that you lay on the table and say, you need to understand this and we fix this problem?
Yeah, I think the typical, I would talk about, how are you thinking about really driving that customer lifetime value? So that's one way to think about it. That you may have a leaky bucket where you're spending anywhere between $200 to $300 to drive that first transaction. But how many customers are coming back and having that RFM model and have repeat purchases? And there's tremendous amount of research and data already exists between Accenture and Bain and others that your highly lifetime value customers are your most, not only spending more, but they are highly efficient in terms of cost as well. So the orientation is more about customer lifetime value versus customer acquisition, and that's where typically we spend time. That what strategies and initiatives that you have to really drive that customer lifetime value versus customer acquisition.
Now, you finding that conversation easier, harder, or the same? I mean, as we all, many retailers have been tied up just trying to get through the COVID era of supply chain challenges, which continue today. Are they starting, do you find, on the whole, to turn their minds as an industry to these kind of higher order metrics, if I could call it that way?
I think it's hard. First of all, when you have key metrics that are already set, that are typically talk about year-over-year store comps or year-over-year your online growth comps. So it's hard to pivot and talk about customer lifetime value. But having said that, progressive companies and businesses are slowly orienting to look at not only how we grow our business, but how do we grow our business pragmatically and profitably, which is really, really hard. For last 20 years, three of us can count only like handful of companies who have even attempted or even delivered results on a consistent basis, from that perspective.
So Amit, can you give us a handle? So it sounds like there's there's obviously a particular part of the value model for retailers that you take a look at it, and it sounds like you help retailers uncover where there may be this leaky bucket or some upside opportunities. But let's dig into a little bit more about how the Narvar model works. I think you've got a few different value propositions. Part of it, as I understand, is around returns reduction, but I think there's more to it. But can you kind of set the stage for us and then kind of dig into how your solution works?
Absolutely. So since we just discussed what we do is really driving that customer retention and engagement. So let's talk about how do we do it. So there are three things that we actually build our solutions and our products that we offer to the industry. One is setting the right expectation on product detail pages or shopping cart and checkout. Really, not just when you place an order and when it's going to ship, but really giving them the choice and convenience on, hey, if you place an order, if you are in Portland, placing an order at 10 a.m. on Thursday morning, when can be really delivered to you versus if you may be in Hawaii or if you're in New York. So really giving that more, setting that promise and expectation and convenience, whether you want to pick it up to in a store or a third party location such as UPS or FedEx stores. So that's where we really help businesses to drive convenience and conversion rate by setting the right expectations and giving the consumer choice and convenience. So that's the one product line. Second is that now once the order is placed, how can we really engage customers proactively? That means whether customer needs an SMS notification or WhatsApp or email, how can we proactively inform consumer that, hey, yes, you have placed an order has 3 items. Those 3 items may come in 2 shipments, whether those are early, on time, or late. So we can avoid, first of all, any call to the call center and use those opportunities to really engage customers and talk about how to use the products, what are the things that they may need to know from setup or installation, or any other product recommendation or marketing opportunities. So really proactively communicating in that waiting period between order placed to order delivered. And then the third product line is really post-delivery, which is in the space of returns and reverse logistics. So similar to shipping, we believe consumers are looking for the choice and convenience, how, when, and where they can return their items, whether item is broken or not as intended, or they order two different units. So whatever may be the case, how do we give that choice and convenience while balancing the SKU profitability for that merchant? And that's where the operational cost and operational rigor also comes into picture, so that we can balance the business needs as well as consumer expectations. So those are the three high level product solutions that we have in the market to help businesses to deliver a more convenient consumer experience while balancing their P&L needs.
So it sounds, just to make sure I'm understanding this, so it sounds like, and I guess this would depend quite a lot on the particular client, and maybe there's a case example or two you could give us, but it sounds like part of the return comes from fundamentally having happier customers, higher NPS scores, which is going to increase their retention, increase their probability of spending in the future. But there's also kind of the hardcore expense reductions, because I think we know that returns can be extremely expensive, both from the shipping costs, merchandise depreciation, as well as obviously there's some negative environmental impacts. Is that right? It's sort of two sides of the ledger, right? Happier customers leads to more spending, greater margin, product margin, and on the other side, you're potentially saving a lot of expenses and product ending up in the landfill. Is that fair?
Exactly. So I think you're right on. So three key business metrics. What are, can we drive higher customer satisfaction scores? So that's one thing. Branded experiences throughout the customer journey. That's number one. Number two, when you're a happy customer, they're returning, so you can drive additional upsells and cross sells with that shopper. And third, while you take care of first and second, how can we do and reduce the operational cost and drive that business profitably? So those are three specific KPIs that we work with merchants to drive the business value.
I'm curious, I'll let Michael jump back in here in a second, but one thing that's just kind of popped into my head as I hear you speak and kind of talk more about the details. I've been on the buy side of this, but I've also worked with a fair number of technology firms that have very good overall value propositions, I think, but they often struggle to figure out exactly who the right client is within the company because of the way responsibilities are distributed, or the value comes, for example, on the customer satisfaction side, right? That might be somebody who, a merchandising person or a marketing person, whereas the cost savings that come out, that comes out of supply chain or store operations. Are you finding that? And if so, how are you overcoming that if that is a real challenge?
And so you're correct. And some of that is also the size of the customer. If you are a small mid-market growth brand, so you may have a head of digital, who may lead all of these functions. But if you go to a true enterprise omni-channel retailer, then yes, then these responsibilities are distributed among 2 or 3 or 4 functions. You touched upon customer service, e-commerce, supply chain and logistics, and maybe even product or engineering. So, just like anything else, you have to, work across the functions and show value, in their respective business areas. So yes, it becomes more challenging, but then there is the unlock that we can offer to multiple functions.
You're in the middle of I don't know if you're in the middle is the right description, but you're part of a vast ecosystem that moves around product returns, and as products move around. How do you work in concert with other tech firms that kind of focus on other parts of the problem? How do you fit in, and would you describe it as that ecosystem? Is it that where you over the years have connected or are adjunct, or are you replacing some of the parts in that ecosystem?
Yeah, so we are a net new solution in the ecosystem. So very rarely we will rip and replace any existing infrastructure. And you are correct, Michael. Especially in a bigger and enterprise business, you have to have this approach of better together, because they may have a marketing cloud already or a customer service solution already. So we have to show an incremental value, not just independently how we're driving business, but incrementally. So case in point, for us to help reduce where is my order or when can I get my shipments, by the way, that is the number one call in the call center or the inquiry that comes in. So 30 to 40% of inquiries are coming in. Where is my order? Where is my shipment? And those are accentuated in the COVID era because of labor and workforce constraint as well as supply chain limitation. So in that particular example, yes, we do work with existing solutions, whether it is Salesforce Service Cloud, Zendesk, or even up and coming solutions like Gorgias in the SMB market. So we have embedded our capabilities in both directions to give that incremental value to our common customers in this particular example.
How has the business and the industry evolved in your mind? I mean, you've both got COVID. Of course, we can speak to that. You just mentioned that over the past couple of years, the COVID era has certainly, to some degree, moved things around, a brief acceleration and kind of, as Steve often describes it, the great moderation. But are you seeing any the evolution of the business in terms of there's third party depots now where people can drop off returns? Like, there's a lot of people, it seems to me, turning their minds to trying to solve in different ways the problems that you're solving. So how have you seen this particular element of the industry evolve?
Yeah, I think in especially in the returns and reverse logistics, I do see a change in mindset in last couple of years. And the context, as I was just describing, is a constraint in workforce. That means they don't have enough labor in their fulfillment centers or even in their stores. And then also inventory delays and limited inventory available. So progressive retailers are seeing returns as not just to give that consumer the choice to return it, but they're seeing as a new source of inventory. As we all know, that inventory sitting in my closet, every day you are losing the sales opportunity. So instead of just looking at sourcing from the manufacturers, now progressive retailers are looking at inventory. How do we get it faster from customers and shoppers' closets? And what we have seen that if you give them the choice and convenience, hey, give this QR code. You don't even have to print a label at home, or you may not even have a packaging. Our research says that 25 to 35% of customers don't even have a printer at home. So if you want to get that return faster, you can give them the convenience of going to a local drop-off point, whether it is a UPS access point or FedEx location, and you can get that inventory faster by 25% and actually put that back on stock. So these are the things that we are seeing in the market where retailers are paying more attention now. How can they run their operations more efficiently?
Amit, I think I saw, if I'm right, that you guys won a Fast Company award for sustainability. Do I have that somewhere close to right, or am I dreaming that?
No, you're right. We were thrilled to be a part of the innovative company in the sustainability category. And, there are a lot of things going on there.
Well, I'm curious before I kind of we start to get towards wrapping up and just kind of understand a little bit where you're going overall. But do you feel like this interest in sustainability in particular is causing more retailers to take a look at the whole returns and exchange process? Is that really a significant change or not?
No, I mean, sustainability is in their minds, but we haven't seen any concrete steps that industry is taking yet. They are more coming from, as you mentioned earlier in your comment, that consumers have higher expectations, and coupled with more cost in supply chain is the driving factor, and especially in the returns and reverse logistics. Not as much that brands are suddenly looking to meet their goals or their milestones for sustainability yet. We haven't seen that play a key role so far, at least.
Well, it'll be interesting to see how that changes, because it does seem to me, not to get too off the topic here, but it does seem like there has been, we know that in general, particularly with the growth of e-commerce, that product returns are going up. And I think there's been quite a bit more coverage in the media about what happens to those products that get returned. I think people think maybe they end up in an outlet store, but as you know, it's not. That's not even close to being always the case. But in any event, perhaps a topic for another day. But so what's next for you guys that we haven't touched on yet?
No, I think first of all, I love to talk more about the sustainability and returns. You're right. At least 30%, if not more, depending on the category, it just goes in the landfill. So it's not hitting any shelf by any means. Now, what's next for Narvar? As I look at reflecting back on last decade or so, and what is in front of us for next 5 to 10 years out, we are really excited to really bringing personalization, not just on the product, not just giving more loyalty and rewards in terms of driving the shopping, but how do we curate the experience in the post-purchase world? Today, it is for the most part is free for all, whether it is shipping or returns. It does not take into consideration the merchandise or the customer themselves. And I think there's tremendous opportunity to curate that experience based on the product, based on the customer and the audience in that post-purchase world, and using data and intelligence to drive that end-to-end customer experience and a curated experience, something that we are really excited about.
Well, it's a really fascinating business. Thanks for sharing more about it. I agree with you 100% that there's not been nearly enough attention paid to the whole post-purchase experience and environment. So thanks for joining us, and great luck to you for the rest of the year.
No, thank you for having me. Thanks again.
If you like what you heard, please follow us on Apple, Spotify, or your favorite podcast platform so you can catch up with all our great interviews, like our discussion with Target SVP Nancy King on their innovative approach to harmonized retail. New episodes will show up each and every week, and be sure and tell your friends and colleagues in the retail industry all about us.
And I'm Steve Dennis, author of the best-selling book, Remarkable Retail: How to Win and Keep Customers in the Age of Disruption. You can learn more about me, my consulting, and keynote speaking at stephenpdennis.com.
And I'm Michael LeBlanc, producer and co-host of the Conversation with Commerce Next podcast, the voice of retail podcast, keynote speaker, and host of the all-new Last Request Barbecue cooking show on YouTube. You can learn even more about me on LinkedIn or meleblanc.co. Safe travels, everyone.